All right, let's see if this recording starts. Okay, recording has started. You guys are once again the lucky recorded session for today. And so we'll be digging into chapter 16 beginning this week, and we will continue to study chapter 16 into the next week. So this is pretty much the only time we have a chapter that overlaps 2-week periods. So we're going to have a little bit of, let's say, buffer time when we can look at the spreadsheet that should be available to all of you on Canvas. Okay, the file is called Financial Calculations. Now, those of you that have taken the class with me before, you guys know what this file is. The idea of this file is to try to get you guys to look into the future and try to think how you're going to plan out your life, right? Because the idea here, and you can tell this file is from last term, right? You can start in 2023 or 2024 and kind of plan out your life for the next 30 or 40 or 50 years. I encourage you to do that. I think that a lot of the things that we learn in this class are not really that practically useful to folks that don't go directly into the financial services industry, that don't become a manager of a firm, and that don't become somebody who trades on Wall Street. So if that's the case, you still want to have something that you took away from the course. And in the same way that I said that chapter 12 will probably be the most important chapter I teach you guys, this financial worksheet is probably the most important thing you can do to try to prepare yourself for the next several years, right? The next few decades. What's the purpose of the financial worksheet? Well, it's to take the knowledge that you learned largely in chapter 12, but also, in the other chapters regarding firm prospects and firm health, and sort of put your own entries into the yellow slots there. As you enter those entries into the yellow slots, the numbers are going to change, okay? And as the numbers change, what you essentially end up doing is you end up planning for the future. So why should you do this? Well, it's not going to be graded, but last class I asked everybody to do it, and I'm asking everybody to do it now. And then I called on people to come up and present their plan. Okay, so this term, this is, again, not graded. Next year, so in case you have friends that want to take my class next term in the fall, you should let them know that this is actually going to be a graded assignment, because the university requires me to do some kind of Excel-based activity with you guys, because Excel is so frequently used in finance. Now, arguably, we should be using more advanced software like R, for example, but people still use Excel, and you need to be pretty nifty with how you work it. Now, this Excel spreadsheet is relatively straightforward, except that you still need to pay a little bit of attention to what you're doing. So let me kind of show you what the entries are right now. And if you download the financial calculator, you'll see these very entries. But I want you guys to also kind of understand that when you put in your own entries, the numbers might change and they require monitoring, so you still understand what is happening. So first of all, this person, like this model student, let's say, it's sort of based on an American student, because when I originally taught this class, it was based in the United States. So we sort of made some assumptions. All right. So this person is graduating from college. Let's say they have $10,000 in their investment portfolio. Okay. Let's say somehow their job is able to qualify them to purchase a small home in the United States. Okay. And so we want to record the value of that home. Right now, we assume they're not having an additional home, right? But you can have more than one. So I wanted to include this column here. They're going to buy the home with a mortgage. Okay, this right here is a mortgage that represents 90% being financed by a mortgage. You can also have other loans, right? Either to finance your second home or to finance something else. And a lot of American students typically have student loans. So I think that hopefully for you guys is not a burden, but it might be. In either case, you want to account for the student loans. If that's going to be in your portfolio. Then you have the portfolio return, which 0.09 is 9%. We're going to assume a capital gains tax rate of 0% for now, but you can play with that number and see how the numbers change. Monthly collected rent is going to be 0 because a lot of people in the United States have like rental properties, so they can buy a second home and rent it out, right? And I know a lot of people do that. I mean, I live down there in the towers in Leo Jignon community, and people have like 4 or 5 homes they're renting out, and I'm just one of the renters. So that's something a lot of people do in the United States and in China. You can assume this tax rate of 12%. So that I assume because their income, which I'll discuss here, that would be approximately their marginal tax rate after the deductions. We assume that the value of the home grows at an average of 5%, which is the case in the United States. You might look it up for what it is in China. I know that property prices sort of fluctuate differently, especially with respect to Chinese residential real estate. A mortgage rate of 4.2, you don't have to use that. You can look up whatever mortgage rate you think you qualify for. Loan interest rate, this pertains to this other loan, okay? And then other loan rate, so one of these, I forget which one, you can look it up in the formulas. One of these pertains to whatever other loan you take, and one of these, the student loan. I bet this is the student loan rate, okay? And so again, 4% is the assumption because in the United States, that's about the rate you can take out loans to get an undergraduate degree. If it was a graduate degree, the rate would be higher, maybe 5, 6, 7%. Okay, you then have some expenses that you can put in here. Okay, these are just some things that students have come up with over the years. You know, I usually go to the class and I ask them, it's like, hey, you know, what do you think our expenses should be, right? And so we have a drop down of all the expenses the students have come up with over the years. And then we also have your income, which is probably one of the more important things here. So this person, we assumed, works 250 days a year, which is about average at 8 hours per day. So that gives you 2,000 working hours per year, which is approximately what most people work, right? 8 hours a day for about 250 days out of the year, which, you know, is what you get when you subtract all the weekends and all the holidays from the 365-day year that we have. And then we're going to assume that this person is a college graduate is going to earn $35 an hour. $35 an hour multiplied by 2,000 is $70,000 an hour. And then, you know, you can input some additional, you know, job numbers here if you have some side jobs. A lot of students will work more than one job. But the idea of this is to kind of look into the future of what will happen, right? And so initially, because the student took out this student loan, their net worth in the first year is going to be negative. And that shouldn't be too surprising, right? You take out, it's like, hey, what happens anytime you do an NPV, right? At first, you have this big negative number, and it's the subsequent years that are supposed to take away from that, okay? And so we assume that the person is making the minimum payments on this loan, what I assume here is that the loan just grows at its rate, okay, which isn't quite the same. And you should, if you want to, adjust the spreadsheet to be a little bit more accurate so that the loan payments, right here, the assumption is 0, so that the loan payments actually come over here and subtract from the loan, okay? So the idea is that I give you a simplistic chart which requires some improvement, but I want you to do that improvement. Tell me if you've modified the formulas, how you've modified them, how did you improve them? But let's say no improvement is made, and we assume that the student loan sort of compounds over time, okay? And the total, investment accounts also compound over time, and that the person continues to take all of their income that is not spent on their expenses, and they put this income in the investment accounts, okay? And so if you make this assumption with this person, right, you see that for the first few years of their life, they actually have a negative net worth, okay? But you can also see that over time, their investments grow, both their investments in their home and, most importantly, the investments in the stock market. And then you can see that this person in, what would it be, from 2023 to almost 2053. So in almost 30 years, reaches sort of this magic net worth of $1 million, right? And why is it magic? Well, at least a long time ago, before all this inflation, it was considered a big deal to have a million US dollars. So I sort of did this for my American students, and I want to do it for you guys too, to sort of point out that under certain assumptions, you can still sort of reach this quote unquote dream of being wealthy, okay? Of being very wealthy, and not just through inheritance or something like that, but even if you have a job where things never improve, you work the same number of days, the same number of hours, and you earn the same amount, over time, if depending on the portfolio you've selected in the stock market, you're going to come over here and you will eventually, even with just a 9% return, which is approximately the S&P inflation adjusted average, you can reach $1 million in 30 years. So you hit 50 years old and you reach $1 million. Now, of course, this is very, very, very rough, right? You should adjust these things for the student loan payments, right? I mean, nobody is just going to let you skirt by without any student loan payments. Should adjust these things for the fact that you might have a different portfolio. So your portfolio return might not be 0.09. You might be somebody that invests in bonds. Okay, let's say you invested in the treasury bonds. Well, what's the return? You remember it from our slides. It's about 3%. If you did that, you're not going to get to $1 million in 30 years. It would take you, well, we basically run out of sample. You just don't get there, right? So it depends on the portfolio. It also depends on, how you address your student loans. If you have student loans, I mean, for many of you, I presume it would read 0. And it also depends on how big of a home you want to buy and how much of a mortgage on the home you're going to take. So all these things play into it. And obviously, if you don't pay attention and you plug in something that violates one of the assumptions, you're going to have some interesting outcomes that you need to modify. One example is this. If you don't take a student loan, you need to come in here and delete these values, okay? And so this is really important for you. What are these values? Well, these are the payments on the loans on the loan that is being assumed within the model, okay? Student loan payment, $150, okay? This right here is 150 times 12. Okay, so the assumption is that you're paying into the student loan and the student loan is also increasing by 4%. So now you have this growing negative number. Obviously, if you were going to do that, you would just zero everything out. Okay, so that's just an example of what you want to do depending on what it is that you plan your life out to be. Now, why is this important? The reason it's important is it's hard to get where you're going in life if you don't plan. Okay, maybe you want to actually have more than this. Let's zero out your student loans just for simplicity's sake. Okay, and let's say you wanted to be a real risk taker, right? 0 point, what do we think? Let's say a 12% return. Okay, now you can become a multimillionaire in 3 years. That's pretty good. But you have to ask yourself, what is that going to cost me? It probably means when you go back to those slides in chapter 12, you're investing in large cap stocks. Okay, it's possible you're even investing some in mid cap and small cap stocks. And think about the variance in those returns. So if you want to reach that, you're going to see your net worth seesaw all the time with the movements of the stock market. You might even consider taking a leveraged position, which is related to the topic we're going to discuss about in this chapter. Leverage is terribly risky, and the vast majority of financial advisors don't recommend it. But some people like to live on the edge, and they make a lot of money very quickly through the use of leverage because it allows you to basically trade on money you do not have. You borrow the money and you trade with it. The good news is if you do, then you make more money than you could otherwise have made. But if you lose money, you've lost money you didn't have. That's a serious problem. And so you go into debt. So you could just play around with those scenarios, and I encourage you to do so. And if you're really clever, what you can do down here is you can generate live stock picks. And if you're curious on how to do it, you can just Google how to do this. But Excel is so advanced, it's smart enough to actually pull the market price for any stock, Tesla, Amazon, etc., right into those cells. And you can even say, well, I'm going to buy 100 shares of Tesla, 200 shares of Amazon, et cetera, et cetera, et cetera. And then that can give you your portfolio composition, which remember, we also studied how to calculate what percent of your portfolio that stock is. You can pull their betas if you want to. You can pull their volatility and other indicators, and you can try to calculate things like this portfolio return. Instead of just setting it at 12%, you can actually pull a bunch of stocks into the spreadsheet and allocate certain amount of money to them via percentage or total dollar amount, and then take their 5-year or 10-year returns, right, and weight those returns, just like we studied in the prior chapter. And then that can actually give you your weighted portfolio return, which is ultimately what you're looking for, and see where that investment is projected to get you. Okay, so why is it important to do this? Well, even though life is not all about money, money is sort of necessary to get where you want to go. And so you want to plan, right? You want to plan, and you want to ask yourself, well, what kind of a job do I need to have in order to achieve the status I want to achieve? Because, let's say you want to, you end up not fulfilling your dream, right? And it's only $20 an hour that you earn. What is that going to do to the numbers, right? You can see things can get very highly negative here. Of course, if you were to do that and you adjusted the number lower, you have to go back through here and figure out if the numbers still make sense. Because obviously, if you have a negative wealth and a negative investment account, that doesn't make sense, right? So if you're only making $20 an hour, I am now making less money than I am spending on the monthly expenses. And of course, you can't take a negative, like a yearly deficit, and add it to your portfolio. That's not going to work. So if you do something like this, what you almost always have to do is modify how well you live. So you live a little worse. Okay, now we're back to the positives, right? So the assumptions of this model are inherently that your expenses do not exceed your wages. I mean, how are you ever going to build a portfolio if that is the case? And that your student loan is you're paying down the interest on your student loan. But what you could do if you have student loans, and maybe this is a discussion for Chinese students, is actually go in there and figure out how much you're paying per month. Okay, and then use that as the actual entry point. Okay, so basically there are these assumptions to the model. There might be a few more, but go through here and try to sort of calculate your future. Okay, see if you could get to the kind of wealth level and affluence level that you want to reach, right? Does anybody have any questions about this? Now, don't slack on it. Don't just say, well, teacher said this isn't going to be for a grade, because the teacher is going to come up here and then you're going to have to do it live in front of your classmates. And then if you didn't prepare and you come in here and, you change the number and everything turns negative, your teacher is not going to be like, oh, okay, you're done. Your teacher will be like, get up there and fix it. That doesn't work. You have to fix your dreams. Your dreams have to be successful. I can't let you leave this class and this is your budgeting. This budget is all negative. You're going to have a negative net worth of 3 trillion. I mean, not 3 trillion, 3 million, 3 trillion. I'm thinking the U.S. government. 3 million. That's bad budgeting. That's the kind of budgeting American politicians do on Capitol Hill. So I don't want you to do that, right? I want you to be somebody that can explain what's going on here, what choices you plan to make in life to get you there, things like that. So this is the file as you should be looking at if you download it from the website right now, and it's going to give you an opportunity to kind of play around with life plans, okay? Fancy cars, fancy homes. How are you going to afford it? An education with a degree in finance is worth nothing if you cannot at least answer those questions for yourself using the knowledge you gained in chapter 12 and chapter 13. Why didn't we do it then? We didn't have enough time. So here you go. we're going a little out of order, but I think that that material is just so much more important than the other material that it's critical that you go over it twice. So next week, there's going to be presentations. And I'll pick you guys at random, unless people want to volunteer. Some people in some of my other classes were enthusiastic and they wanted to show people what their plan was. So I think that's also useful because you get the feedback of your classmates like, hey, you forgot this expense. Or you really think your portfolio is going to make 20% every year? Like, that seems optimistic. I mean, yeah, I mean, sure, anybody can come up here and say, oh, yeah, 30% every year. Look at this. In 30 years, you have $100 million. Like, we all dream, right? But that's probably not realistic. And that's where the feedback from your classmates and from me is going to say, well, while achievable for short periods of time, these kinds of results are difficult to replicate in the long term. Okay, so work on that. Obviously, this was initially created for an American audience with American expenses. So plug in your own expenses and obviously keep the currency either dollars or RMB. You can't be switching between currency or it would be madness. So that's something that we'll probably go over next week. Now, what about this week? So ironically enough, I'm still going to talk about stock returns for a little while because they're probably the easiest way to demonstrate the effect of leverage. And we'll talk about leverage in the context of the firm in this chapter. But what you need to understand is that leverage is when you basically take on debt and then take the money that you got by going into debt and invest it in your business. Okay? So what is the benefit of leverage? Well, let's not think about the firm for a minute, even though I'll explain what the benefits of leverage are there. Let's think about you when you trade stocks, okay? Because in a really intuitive way, leverage affects what your calculated return is, okay? So let's say that I bought a stock at $100, and let's say the stock was the S&P 500 index. The average return per year on the index is what? Chapter 12, huh? Well, according to chapter 12, it's roughly 12%, unadjusted for inflation. So if you don't discount inflation out of it, you make about 12% a year on average. Now, so that means that I start with $100. I invested in the S&P 500. It has an average year of returning 12%. So at the end of the year, I have $112. And how much did I make? Well, what's the end number? 112 minus 100 divided by 100, right? That's our formula from chapter 12 or 13, I forget. Okay, so that means I made the 12% that I was expecting. I'm getting some confused looks. I'll point it out. So 112, right? Minus 100 divided by 100. Okay, that equals to 12 over 100. Okay, and so that's 12%. All right, that's exactly as expected. Now, most of the brokerages out there, the retail brokerages, will let you take a leveraged position. So if you go to Fidelity or Charles Schwab or Interactive Brokers, you don't actually have to have $100. You can just have $50. How does that work? So I come in, I have $50, and I tell the brokerage, well, you're allowing me leverage, right? Which means 2-to-1 leverage. So when I first take the position, I'm allowed 2-to-1 leverage, meaning that for every dollar that I bring, the bank or the brokerage will lend me another dollar. So now I take $50, I double it up by taking out a $50 loan. Now I have 100. Now I invest it into the S&P 500 and I get a 12% return. However, is my return still 12%? What's my return? You're right that it's not 12%, so that's good. Uh-huh. Yeah, so let me show you how to calculate it. I'm not exactly sure what you're saying. So the top is going to look the same, right? Because you sold the stock at 112. Okay, that's right. The stock still cost you $100 at the start, but you didn't put in $100. You only put in 50. So what you do is you sell the stock, you give the bank back its 50%. Okay, or it's $50, and you kept 50. Well, you don't have to be much of a mathematician to see that when you cut the denominator in half, your return is actually doubled. Okay, so the way this works, I mean, it's pretty nice. Another way to sort of think about it is like, what are the mechanics? Well, you bought it for $100, you sold it for 112. Okay, so out of the 112, how much do you keep? Well, yeah, I mean, that's not going to be. I'm trying to phrase a way. It won't be the correct answer in any way. You keep 62, right? How does that? How did that happen? Well, $100, or you have the $112. Where's my eraser? Oh, no eraser today. Okay, you have the $112. Okay, but 50 of it belongs to the bank. Okay, so then minus 50 is going to be equal to what? 62, right? Okay, then you divide 62 by 50, which gets you what? 24%, right? Because it's equal to this, it would be the same thing as saying 124 over 100, right? Which will be equal to 24% gain. Okay, because you would subtract 1 minus 1 there. Leverage works, and basically the idea is that it sort of plays on percentages. You can make the same investment, but you can seem just as or twice as successful as if you did not use leverage, right? So a person investing in S&P 500 without leverage on average earns 12%. In the average year, that's an important caveat. In the average year where the S&P 500 returns 12%, someone who is leveraged 2 to 1 would have a much higher return, right? He'd have 24%, and that would look impressive. Okay, so there are a lot of people that use leverage to try to boost their returns in actuality, even though they're really making the same investments as people who are not using leverage. Well, that happens with stocks, but it also happens with firms. And what I'm about to show you is a more complex way of seeing how firms can alter their earnings per share estimates, for example, using leverage. Okay, because firms, just like the investor in this case borrowed $50, right? Firms can also go to the market and borrow. They don't have to finance everything with stock. That's what we've been talking about up to this point. So let's just keep this in mind, that even all of you today, again, this is not financial advice, because as Warren Buffett says, you can go broke with leverage really quickly. Like that's because think about it, if the return is negative. Let's say the S&P 500 goes down 12%, which does happen. So if it goes down 12%, okay, what would we have? I'm going to change all these numbers with this eraser. If it goes down 12%, now we have 88 here, right? Okay. Now it's no longer positive 12, it's negative 12, and your return is negative 12, which does happen and has happened to me many times. I've held S&P 500. If you look at its return over the course of the last 15 years that I've been holding it, give or take, there were a few negative 10, negative 12%. Okay, so what happens with leverage? Well, this is no longer 112, right? This is 88. So what happens over here? Negative 24, right? So now you actually have kind of a serious problem, because over here, you had a return of -12. So at the end of the day, you have $88 in your bank account, and then you lost 12, right? Okay. With leverage, you only started with 50, right? And you levered up to 100. Well, you lost $12, right? So now, out of the 100 that you had, okay, now you have to give back the loan, and then you have to give back the 12 bucks. So now you got 38 out of the $50 that you started with, which proportionally is a much bigger loss, right? Because again, you can scale everything, right? So this is equal to 76 over 100, right? Which is equal to 76%. So the leveraged guy only has 76% of his original investment left. The unleveraged guy has 88%, right? Okay, so just like you could get rich with leverage very quickly, you can also lose a lot of money very quickly, right? So if you lever up and you pick the wrong investment, you can lose a lot of money. That can happen to firms too. So the benefit of leverage is everything is basically on steroids, right? It's a lot bigger than it otherwise would have been if things are good, and things are a lot worse than they otherwise would have been if things are bad. And again, don't necessarily try this at home unless you really, really know what you're doing. But just understand that a lot of people go broke this way, because it's possible for the S&P 500 to lose 30%. Let's look at what that looks like for a minute. So lost 30%. So that means it's, or let's do the financial crisis. Let's do 50%. Really 54%, but okay, let's do 50%. So 50 minus 100. Okay, now you're down what? 100%. Literally, you've gone to zero, right? How did this happen mechanically? Well, $50 is, so you started with $100, 50 of it is yours, 50 of it is the bank's. Okay, you lost $50, right? So you still owe the bank 50, right? So whatever is left in that portfolio just goes directly to the bank. You now have nothing. Okay. Now, in reality, at some point in the middle of the year, the bank will give you a margin call. It'll say, hey, look, you're going to go to zero. We have to protect ourselves. If you do not put more money in your account, we're going to go ahead and sell your position at a loss, and that's it. And so then people can't honor the margin call, their positions get liquidated. That further drives the price down, by the way, because now there's even more selling pressure, and people lose a lot of money this way. So I say that to say this, really, if you're playing around with leverage, it's a very dangerous game. Can you make money that way? Yes. Have I made money that way? Yes. But I don't do that anymore. I guess after I became a finance professor, I was like, you know what I was doing when I was a young kid was really risky. But, you know, maybe I also got older, and my appetite for this kind of risk, you want to avoid risk when you become older. And so I've become older, not that much older, but a little bit. And so I'm just kind of like, it's too much risk. I don't want to play these games anymore. But just know that a lot of people, unfortunately, in the finance profession, they get into this kind of stuff, and it really has a bad impact on their mental health, because when you're losing your own money, it's bad. When you're losing the bank's money, it's worse. And there have been cases where people have actually wound up in debt to the bank, so the bank could not liquidate in time. And so you actually wound up owing the bank $1 million. That's a serious problem. But you can see how that can happen here very easily, right? I mean, let's say that instead of 50, it was, it was a loss of 90, like the Great Depression, right? Now you have 10 right here. This is not good, guys. This is very, very bad. That would be a loss of what? Negative 180? Okay, well, guess what? You owe 80% of that to the bank, in addition to your money being gone. So just be aware that's a dangerous technique. Okay, this is intuitive, right? All of you can take these crazy dangerous positions. Okay, well, let's look at what firms do. So we'll look at financial leverages in the firms, like we just talked about. We'll talk about taxes and bankruptcy and how they impact firm capital structure. And then I'm going to ultimately talk to you guys about a very famous paper by Modigliani and Miller, I believe like 1963, I'd have to look it up, where they argue that under certain assumptions, again, like many things in economics, this argument only works under a certain set of assumptions, but under a certain set of assumptions, they'll argue to you it doesn't matter. They'll say, you know what, no matter how much leverage a firm takes on, it doesn't matter. The idea being that investors can themselves take leverage or unlever themselves in the holdings of the firm. So if the firm has a capital structure that is non-ideal, the people that own the firm in their own portfolios can create a more ideal capital structure. Okay. All right. So this is the chapter outline. All right. So the idea here is that firms have the ability to fund their projects using issuances of stock, which does not involve debt or leverage, or they can issue bonds and actually buy back stock. And that does involve leverage. So leverage at its heart is basically when you take out a loan to fund what otherwise might have been funded by the issuance of stock. Okay, so if you want to increase leverage, you issue debt and then you repurchase the shares of your stock that are outstanding on the market. Not all of them, but some of them. Okay. And if you want to decrease your leverage, well, you issue shares, right? We talked about new share issuances in the prior chapter, and then you use the money that is generated from issuing those shares to repurchase debt. Now, the idea is that the perfect allocation of bond financing and equity financing, leverage versus non-leverage, should increase the return for shareholders. At the end of the day, at least in pure theory, managers should be trying to maximize shareholder returns. What corporate finance literature that you'll study in graduate school, if you go there, will tell you is that frequently that's not exactly what happens, because it's the executives that ultimately, and the board, that decide the capital structure most of the time. They, instead of maximizing shareholder wealth, maximize their own wealth. Okay, and it's very, very difficult for them to get them to do exactly what you want to. So if you took FIN 3310 with me, we talked about some ways you can try to incentivize the CEO to act exactly as you would as the shareholder. But the CEO always has some ulterior motive. Okay. And so that ulterior motive means that rather than maximizing stockholder wealth, maybe they really want to maximize their own wealth. And if you think about executive compensation, which frequently rewards executives for growing, let's say, the earnings per share by a certain percentage, imagine if you could use leverage to change that percentage. I mean, let's say that let's say I was to give you a bonus, $100 bonus, if your portfolio earned 20% or more. Okay. Well, forget these losses for a minute. Let me erase this part. Okay. If you had a portfolio that could reach 20% or more, you wanted a portfolio that could reach 20% or more, and you could only buy the S&P 500 index, which one of these would you choose? Would you choose leveraged or unleveraged? Well, I think a lot of people would choose leveraged, because you're trying to get a return of 20% or more. On average, the S&P 500 doesn't return 20%. On average, sometimes it does, but on average it doesn't. But if you lever up, right, then yeah, you can hit 24%, even if the S&P 500 has an average year. In fact, even if the S&P 500 only returns 10% instead of 12, you can still hit 24% because you levered up. So even in your own portfolios, you can quickly realize that if I give you the right incentives, you would arrange your personal portfolios differently to meet certain goals. So what I would say to you is, because some CEOs are incentivized in a particular way, and because their compensation, their bonuses are based on the performance, such as earnings per share, okay, they might have an incentive to modify the capital structure. Okay. Now, what I will argue at the end of the class is that if you actually have a firm where everybody is behaving well and the CEO is not trying to maximize his own wealth, but trying to maximize shareholder wealth, there are ways that you can go about having a firm with different capital structures that allow the investor to just adjust their own portfolio instead of adjusting the firm, so that the firm is just as profitable. It's funded with all debt, all equity, or some mix of the two. Okay. So what's the effect of leverage? Okay. When you finance with debt, we increase interest expense. That's something I didn't talk about here, but it actually does apply if you trade on margin. If you trade on margin these days, because the Federal Reserve's interest rates are so high, you know, it probably is going to cost you like almost 10% per year. So if you were to hold this S&P 500 position per year, I hate to tell you this, but you would lose 10% to interest, because you have to pay the bank, right? The bank is giving you a loan and they're going to collect interest on that loan. And that's true for firms as well. I mean, if they finance with bonds, okay, they have to pay those coupon payments. There's no way around it. With stocks, remember, they don't have to pay dividends, okay? They get to vote on the dividends and they can elect not to pay dividends. Facebook, for, you know, what is it? It's all, for almost 15 years, and only now has begun to pay dividends. So that's the problem with debt, is that you're going to have these periodic interest expense payments that will require some liquidity from the firm. Now, if you have a good year, okay, we'll have a lot more left over for our stockholders if we are in a leveraged position, just like from your personal portfolio, right? If you have a good year, you're going to have a much greater return. Okay. But if we have a bad year, this is where the trouble comes in. We still have to pay our debts. Okay. We can't just go to the debt holders and say, well, we had a bad year, we're not going to pay our coupon this quarter, or this semi-annual coupon. You still have to pay it. Okay. And so just like leverage amplifies your return in your own personal portfolios, it's also going to amplify EPS and return on equity. Okay. So let's go through this Excel spreadsheet one by one. Okay. So remember, the CEO might be getting paid based on his earnings per share. He might be getting paid based on the return on equity. And so I'll let you guys ponder which situation the CEO would prefer. And, you know, does he want to leverage or does he not want to leverage? Okay. So let's say you have a situation where you've got this firm, and the firm on the left, which says current, okay, it has $5 million worth of financed assets, and all of them are financed using equity. Okay. Share price is $10 a share, and the shares outstanding are 500,000. Okay. Here's what the firm wants to do. It wants to go out and get debt of half of the value of its assets, buy back some shares that are out on the market. It won't buy back all of them, but it'll buy back half of them, so that instead of 500,000 shares, there's only 250,000 shares that is outstanding. Okay, now this is going to change the debt equity ratio. Remember, debt equity ratio is just how much money is financed by equity and how much money is financed by debt. Here, we didn't have any debt. Okay, so it was 0 over 5 million, which is 0. Here, we do have debt. So it's going to be 2.5 million divided by 2.5 million. That's going to give us 1. Okay. Now, in order to keep the share price the same, it must be that the shares outstanding were halved. Okay, so we bought back our shares outstanding. So now let's see what happens when we go to our income statement and we get our EBIT number, how that translates into net income, ROE, and EPS. Okay, so again, over here, this is the no debt table. And then over here is the debt table. Okay, so let's look over here. So let's say that you've got these 3 possibilities. Again, we're doing some scenario analysis here. Okay, so recessionary possibility is 300, expansionary is 1 million, and expected is somewhere in between, which is the mean expectation, right? Okay, so here we didn't pay any interest because we don't have any debt, right? We're completely unlevered. And so the net income is just going to be exactly what EBIT was. Now, what is the return on equity? Okay, well, here you're gonna go over here. By the way, here's our formula. Okay, you take your equity, that's going to be in the denominator, and you divide the net income by that equity. Okay, so 6%, 13%, 20%. Worst case scenario is 6%, best case is 20%. Okay, now what's the EPS? Okay, in case you forget the formula, right? You just take the earnings, which is your net income, and divide it by the number of shares. Okay, so 60 cents, $1.30, or $2. Okay. Now, again, if you're be thinking about this, the CEO is probably incentivized to hit one of those numbers. Okay. He or she probably is being incentivized to hit at least the 1.3 and probably the 2.0, right? The $2 of earnings per share. Okay, because we want the CEO to reach for the skies, right? We want the CEO to do well. We don't want to compensate him for like the worst possible outcome. I mean, why are we paying him to give us the worst possible outcome? We want the CEO to do well. So here you can see that the CEO can hit an ROE of 20% and can hit an EPS of $2, but he basically has to be in the best possible scenario. Now, let's look over here, okay? So now we're looking at this again, and let's say that we have all the same scenarios. Recession, the EBIT is 300,000, expected is 650,000, and expansionary EBIT is going to be 1 million. All right, now, when we come here, we have to pay the interest. Notice that we have to pay the interest no matter what. Okay, so whether we're in a recession or an expansion, we can't come out and say, sorry, we don't have the money today. We're in a recession. No, we have to pay the interest. Why do we have to pay the interest? Well, because we signed up for this debt of 2.5 million. Okay, and the interest rate is 10%. Okay, so 10% of 2.5 million is 250,000. So that's what we paid right here. Okay. That's going to reduce our net income. Okay. Before we would have 300,000 there, but now we have 50,000. Okay. Before we would have 650,000 there. Now we only have 400,000. Okay. So it reduced the net income. Now, remember, that's not necessarily bad because it means we don't have to pay as much in terms of taxes. But it also does some good things if I want to present myself as doing really well as the CEO. So let's look at our expected and our expansionary outcome. Okay, so right here, I'm going to highlight them. You would agree that the CEO can show bigger numbers, right? Like if you look at that, ROE is 16% in the expected case if you're levered, but only 13% if you're unlevered. So imagine you're threshold for the bonus was 15%. Such a natural number, right? Show us an ROE of 15%. Well, which capital structure do you think the CEO is going to take? Right? He wants to take the capital structure that allows him to hit that, that figure. Okay, the same thing when it comes to earnings per share, right? They are going to be higher for the levered case, even though really it's all the same. Like your EBIT was identical, okay, and your net income was actually even less. But the reason for that, like you guys are like, why is this happening? Well, look at the denominator. Okay, the denominator is shares outstanding, and we took the shares outstanding and we cut them in half. So by making the denominator smaller, you really make your numbers look better. Okay, and the same way here. Okay, look at what the denominator was. We took the dollar amount of equity and we cut it in half. It used to be 5 million. Now it's 2.5 million. Okay, so now on paper things are going to look a lot better. Okay, but now I want to also bring to you the nightmare scenario. Okay, which is here. You see, the CEO, in order to try to reach his figure of, let's say, greater than $1.50 for your EPS and greater than 15% for ROE, he took the leveraged situation. But he didn't know, like he took it at the beginning of the year, he didn't know if the year was going to be recession, expected, or expansion. He didn't know that a priori. And so it's possible for the CEO to really miss his figures. Okay, so he can, in the bad year, he's barely making anything in terms of EPS and ROE. So that's the challenge. So, it's possible that the bonus, like let's say the bonus structure was bonus as long as your ROE is greater than 5%. Still a nice round number, but now that CEO will always say, go here, right? Because there's no chance in the unleveraged outcome that you perform less than 5% on your ROE, right? So you can see that depending on your executive compensation, I can take different positions in terms of levering my firm or unlevering my firm to hit those targets. Okay, so for better or for worse, just understand that, yes, Modigliani and Miller, under certain sets of assumptions, argue the capital structure doesn't matter. But you can see it matters to the CEO. It 100% will matter. And it'll also matter if I give you different incentive structures. Let's say I say, okay, I will pay you $500,000 if you're above 5%, but I will pay you $3 million if you're above 25%. Okay, now you have the decision, because it's possible that you end up in that recessionary outcome. So then you want to make the $500,000 and go no debt, unless you think you're going to be an expansion instead, in which case you don't want to miss the opportunity to make $3 million by making greater than 25% on ROE. And that's the dilemma for the CEO. Now he really has to pay attention. Where do I think I'm going to be next year, right? So all these things can affect the capital structure decision. Okay, back to the slides. So you can see that there's all sorts of variability of ROE and EPS. But hopefully what you're able to see is that the variance is greater for the leveraged firm. Okay, there's more upside and there's more downside. Okay, so the greater the amount of financial leverage, the more this is going to be the case. Because again, here the person was levered 50-50. It doesn't have to be 50-50. It can be 75-25, something else, whatever people are, whatever, capital structure people are still willing to lend to you. You can take all sorts of interesting leverage position as a firm. For investors, thanks to our many financial crises, you're generally limited to a 2-to-1 margin when you first take the position and a 4-to-1 margin to hold the position. It's beyond the context of this class what all that means, but basically they're not going to let you, bring in $10 and borrow 90. Okay. If you bring in $10, you can borrow 20. And moreover, the brokerage understands that there will be price fluctuations to where it will look like you're borrowing more than the initial margin of 50%. In which case, basically, they'll say, or of 100%. No, 50%, excuse me. In which case, they'll give you a little bit of latitude to where they're not going to margin call you, even if after you bought the stock on margin, the stock plummeted. But once it plummets a certain amount, until you're 4-to-1 leveraged or greater, then they'll margin call you. Okay, so those are the current rules. For firms, those rules don't exist, but they're regulated by the market. So basically, it means that the market is just going to say, hey, no, we're not going to, we're not going to lend you anymore. Like or we'll lend you at really exorbitant rates if you're trying to leverage like 10-to-1, for example. Now, there is such a thing as, this is the EBIT, where the earnings per share is the same under both the current and the proposed capital structures. Now, you've seen this before, like we've talked about break-even points when we're looking at NPV and IRR, right? You remember this. Well, just as easy, we can figure out an EBIT at which point the EPS is crossed. Okay, so if we think the EBIT is going to be greater than the break-even point, okay, the leverage is beneficial. If we think it's going to be less, then we don't want to take the leverage. So once again, this is a chart where, the x-axis is going to be the EBIT and the y-axis is going to be the EPS, the earnings per share. So let's see if I can get this graph to work. Okay, it's critical which button I hit here. It's not cancel. I'm pretty sure it's edit existing. If I hit convert, something terrible happens and I can't fix it. Okay, good. That was the right button. Okay, you see, that was a great example of a recessionary scenario, the mean scenario, and a very good scenario. So we got the very good scenario this time. All right. So this is kind of what it looks like, and it looks like they just used the data we have. Let me check what their data was. Yeah. So this is the same data you saw in the prior chart, and they basically just graphed these points. Okay. And so when you graph them, you can see that the unlevered scenario is the less exciting graph, right? Because it's flatter. And flat things mean you're not going too fast or too slow. It's not too risky, just carry on as you were before. Okay. But you can see the steeper line over here is the line that is associated with leverage. And you can see that things can, as EBIT goes up, EPS goes up really fast. And so that might look like it's good. But if EBIT goes down, if you find yourself in a nightmare scenario, you're going to be worse off. Okay. And so once again, because finance deals with allocation of resources under the assumption that you're going to face certain risk profiles, this is, just a visual way to kind of understand that. All right. So how do you calculate the break-even EBIT point? Well, what you could do is you could go in and you could just plot it, right? So you could try to figure out where this point is precisely. Okay, just see where the lines intersect. Okay, but here what you could do is you can say, all right, well, we can put EBIT over 500,000. Okay, which is going. So this is the unlevered situation, and then we can look at the levered situation. So EBIT minus the interest expense divided by the number of shares that are outstanding. They really should have used like different numbers here so you could tell which one's which, but you can just listen to what I'm saying. Again, this is the number of shares that is outstanding, and this is the interest, and this is the number of shares that is outstanding. Okay, well, now you have one equation and one unknown, which you theoretically should be able to solve. Okay, so the next step would be just to get EBITs to one side. Okay, so this is this is another way, excuse me, you can rewrite it. You can see they've multiplied through by 500,000. So that gives you 500,000 over 250,000 times this top number, which is EBIT minus the $250,000 you have to pay in interest. Now you come over here and you multiply through, because 500 over 250,000 is just going to be 2. So that'll give you 2 EBIT minus 2 times 250,000. Okay, that gives you 2 EBIT minus 500,000. You subtract EBIT from both sides. Okay, and then you add, so minus EBIT, that gives us 0 here, minus EBIT, that gives us 1 here, and then you add the 500,000 over to the other side. And so now you have EBIT of 500,000. Okay, so at an EBIT of 500,000, which again was not one of our possible scenarios, but we just know, that the earnings per share are going to be 1. And so let's kind of take a look at the chart for our sanity. There's the 1 right here. Well, I'm not, my hand is not steady enough to draw that line perfectly, but hopefully you're convinced that this is about 500 and this is about 1. Okay, on the chart. So anyway, algebra works, and that's always reassuring. Oh, look, my office hour notification. Come to my office hours. Oh, that's actually really good. I meant to say, tomorrow I'm going to have extra office hours because remember I got stuck on my flight, so I couldn't make it here until Thursday. So I wasn't there for my office hours on Tuesday or Wednesday. So tomorrow I'm going to make up for those office hours. I should be in my office from 4 p.m. until 9 p.m. So that's like the lower bound and upper bound. Any time between then, you're free to pop in if you have any questions. And if you want to set up some kind of a Zoom or Teams meeting, I'm also available for that too. So just letting you guys know, some extra office hours. I need to remember to mention this to the other class so everybody knows, so that you guys are not missing out on your time with your professor. Okay? Now, all right. So that worked out. All right. So what could we learn from what we just looked at? Okay, so the leverage you want to take matters based on your EBIT expectation. Okay, so if you can accurately predict your EBIT, and you can accurately predict the state of the economy that controls that EBIT, okay, that should tell you which capital structure you should hold. Okay. Now, leverage generally increases returns to shareholders under the expected scenario. Okay. At least in the setup that we had, as long as there's going to be this positive effect in the expectation. Okay. Having leverage, right? Again, the expected return of the S&P 500 is 12. If you have leverage, you're going to get 24. Okay. So usually, if things work as expected, leverage is going to be beneficial to your firm. But again, in finance, you always have to consider the catastrophe option. And the catastrophe option, the recessionary option, cannot be discounted. And it sort of keeps people honest because it prevents individuals and firms from being over-levered. Okay? So shareholders are exposed to more risk under the leveraged capital structure, and it allows the CEO, if he wants to sort of increase his own compensation package if he knows on which basis compensation is going to be granted. Now, what's tempting is to say, well, the impact of financial leverage on the expected return of stockholders and the riskiness of the stock, that means that capital structure decisions are okay. But I'm going to argue that under certain assumptions, that's not the case, right? So you can clearly understand in that scenario, let's say you were the investor, okay? And let's just pretend, and that's going to be the Modigliani and Miller model, that you had access to basically whatever leverage you wanted, and you could borrow at the same rate as the firm. So the firm can borrow at 10%. You, as a person, can also borrow at 10%, right? That's a very wonderful thing to have. I mean, it's one heck of an assumption by Modigliani and Miller, but it's an important assumption to make this proof work. If that's the case, okay, just understand that you as the investor can essentially use this concept of homemade leverage, okay, when you use personal borrowing to invest in stock to recreate a levered firm. So if it is a really good idea for the firm to be levered, okay, and for some reason the firm is not levered, then you yourself as the investor can just in your portfolio make the firm look as if it is levered. Okay. On the other hand, if you see that the firm is levered, but you know that a recessionary outcome is coming, and for some reason the CEO or the board, the leadership of the firm, they don't adjust the capital structure of the firm, that's okay. You can just adjust the capital structure by using some of the sort of tools I discussed here. Okay, you can take a leveraged or an unleveraged position in the firm itself. Okay, so because shareholders themselves have access to leverage, the idea is that in some instances, the lever under certain assumptions, the leverage of the firm is actually not important. Okay, I still have some time, so I'm going to talk about homemade leverage and send you guys home with that thought. We'll pick up next class where we leave off here. So let's say you buy 100 shares with the proposed capital structure and provides the same outcome as buying 200 shares within the original capital structure. Okay, so to buy those additional 100 shares would require the investor to take a loan of $2,000. Okay, now if he can borrow at the same interest rate as the company, okay, hasn't he just essentially created a firm in his portfolio that is leveraged, right? So the idea is the company adopts what the unlevered capital structure, right? Because any stock proposed capital structure can simply create it using homemade leverage. So if you buy 100 shares with a proposed capital structure, okay, it provides the same outcome as buying 200 shares within the original capital structure. So if your firm is not levered like you want it to be levered, hey, that's okay. You just take the leveraged position in the firm by buying twice as many shares on loan. Okay. And so there you go. So if you go back to our example here, where are my things here? Okay. If you have a firm that's funded with all equity, okay, and now it switches to, and you think this is not ideal, right? Let's say you hold, what do you think? Let's say you got $100 in this firm. Okay. So that means that you hold 10 shares, right? So what can you do? Well, you could just say, well, if I want to look more like this, I can go to my bank and say, bank, give me another $100. I already have $100. Give me another $100 and I'll buy another 100 shares of the stock. Okay. And so now I am also just as levered as the firm should be. Okay. So now my returns as a stockholder, to the extent that they're connected to things like the ROE and the EPS, will be the same as that of the proposed firm rather than the current firm, because I was able to take that leveraged position. And so in my little portfolio, maybe not everybody else's, but in my little portfolio, the firm actually is leveraged, right? Vote in board member. Just do it myself. It's nice. And in a world where investors are rational, I'm not the only guy doing that, right? Because everybody, all the investors are like, you know, we're pretty sure it'll be expansionary. So we're also going to lever up on this firm. Okay, so that's the basic idea. All right, so any questions, comments, testimonies about that? All right, you're good to go. You're free. I'm going to post this video. Let's see, stop sharing.